Good afternoon, ladies and gentlemen. Robert Rayburn here from Life Pro Asset Management. I am joined by our analyst, Tim Devlin. Tim, say hi to the crowd.
Hey, welcome everybody.
And, as usual, what we're going to do today is provide a market update in terms of what are the factors that are really impacting the overall stock market, but more specifically, what are the things that are working, not working in client portfolios, and what is short-term noise versus long-term substance. So we're going to kind of divide all of those factors today like we do every week, but more specifically, the theme around this week is around asking the right questions. And there's a reason for that. And we're coming over that 1-year anniversary to a really tough period for our country, the world, and our families. It was March of last year introduced a whole level of uncertainty that many of us have never experienced in our lives before. And it's not just about investing, right? It was about the health of our families, our loved ones, our friends, and our fellow Americans, our fellow global citizens. And, yes, investing is important, and it's important that we adjust our estate and our portfolios for the long term. But this was a whole new level of emotion. And what it really did, though, is that it tested our process, right? It tested how do we invest not just through a correction, but through a health emergency, through something that is impacting not just our money, but our loved ones. And if we can get through a process, we can get through a very emotion-driven market sell-off such as March of 2020, we can really apply that framework to almost every other type of stock market correction. Why? Because at the end of the day, all we have is our health. And if we can be successful through periods such as that, then we'll get through any other type of market correction. And that's what we're going to go through today. What were the do's and don'ts of March of 2020, and how can we apply that in the future? So I'm going to go ahead and share my screen here. And, really the three things that we're going to focus on today are, as we said, those lessons of March 2020, and how can we apply that to future market corrections. The Federal Reserve policy. So we saw the FOMC yesterday release its latest statement and policy and what they see for interest rates going forward in the future and what they see in the inflation pipeline. Very important, because we know some of that weakness that we've seen over the last 3 to 4 weeks has been tied to this idea that inflation is returning and that interest rates are going up, and that could be bad for certain types of companies that are more growth oriented. So we're going to go through that. And then thirdly, perceived inflation. What is it? Is it real inflation or is it normalization? And what we're going to show today is that what we're going through today is not inflation, but we're just going back to where the economy was in February of 2020. And so what we need to do is pull out our February 2020 playbook and say, what are the types of companies we want to invest in had we been back in February 2020 ex-COVID? It's just normalization, ladies and gentlemen, and we're going to show that in the charts. So real quick here in terms of overall performance. So what we see so far in 2021 is that our strategies are down by around 3.3% after fees. Now, the important number, in my opinion, is looking at those 1-year, 2-year, 4-year numbers. And what we see is once you stretch out that performance beyond just 2.5 months, what you see is 154% performance. In other words, 100% outperformance versus the S&P 500. And if we go back to inception, we're up 216.74% after fees. And how have we done that? It's not just because of stock picking, it's because of how disciplined we've been able to implement our investment process through good times, and more specifically through uncertain times such as March of 2020, December 2018, and this recent growth correction that we've seen over the last 2 or 3 weeks. So we want to make sure we maintain that discipline, stay focused on best of breed companies that are going from good to great, and have business models that are well positioned for long-term secular growth. So 1 year ago, Tim, I don't know. I mean, obviously you remember what it was like a year ago today, but it was scary. I remember going for a walk with my wife, and you were down a street called Cedros, and there was no cars, no people. It was literally like out of a movie. And you get back home and you see the futures are down down 5 or 6%. And I think actually a year ago today, the stock market was down. The S&P 500 itself was down 11% for one day. That's a hard conversation to have with clients. It doesn't matter how disciplined you are. No one likes to see that. Professional investors, retail investors, that's a hard sell-off to swallow. And the good news is that I think through that entire process, what we saw was our clients were so incredibly disciplined. We experienced very few redemptions through that month, and in fact, it was actually one of our largest net inflow months for our firm since we started the firm. And I think really what we have to do is look back and say, how did we feel during that sell-off, right? We saw headlines such as this article I put here on the left-hand side, and it's just, you see this all the time during stock market corrections. The one thing that March 2020 was no different than any other sell-off is you get these headlines, right? And what media does is that they sell panic. And what we do is we go back and ask ourselves 3 basic questions. And these questions can be applied to any stock market correction, ladies and gentlemen. And that is, what are the structural trends leading the market? Great example, a story I always like to share with clients and advisors, and I'm sure some of you on the call today have heard me walk through this story. I remember in September and October of 2008, the banks were falling apart, the market was selling off, and I was walking through the mall, and it was actually to go to the subway. I wasn't spending any money at the time, that's for sure. And people were lining up, camping out at the Apple store to buy an $800 iPhone. And it just blew my mind away that in the midst of skyrocketing unemployment, in the midst of uncertainty, the banks collapsing, the stock market selling off, that this smartphone cycle was stronger than that. And that's really what we like to turn to during times of uncertainty. You say, what are those structural trends that are A, leading the market, but B, more powerful than the short-term disruptions that the global economy can throw our way? That's the first thing. The second question, what are the companies leading those trends, right? So if we think back to 2008, 2012, 2015, smartphone cycle, what's the company leading the charge? It was Apple at the time. E-commerce, what was the company leading the charge at the time? It was Amazon. So what do we want to do? We want to identify those companies and then invest in them and stay invested in them, not panic through any sort of correction. Thirdly, are these companies doing better or worse since the sell-off began? Great example, we're going to walk through this, is a lot of e-commerce companies were actually selling more widgets in March of 2020 than February of 2020, yet the stocks were off 20, 25, 30% or more. That's an opportunity to stay disciplined, stay focused on the long term, or if you do have dry powder on the sidelines, to put that money to work. Because your wealth is not created over 2, 3, or 4 weeks. It's created over 2, 3, 4 years, 5 years, 10 years, 15 years. That's how people become wealthy. You have to focus on the company, the opportunity, and make sure you have that time horizon to realize that overall wealth creation.
Yeah,
So,
Rob. So
yeah.
one of the things that I think we often hear is kind of a misconception around what tactical investing means. And I think the first thing clients always think of is going to cash whenever the market's going down.
Absolutely.
I think this is a really good way for clients to look at it, right? If the market's going down, ask yourself these questions. Because, back in March, we used that opportunity to rotate some of the names we had, right? Um, Going to cash wasn't necessarily the right move in that sense.
You're absolutely right. It's sort of like giving morphine, morphine to someone that suffered, a really bad injury, and it heals the pain by going to cash for a couple of weeks, but long term, it does a lot of long lasting damage. And the reality is there are moments in time where going to cash can make sense. Absolutely. If we're sort of at the end of a business cycle, we're going through a credit crisis, um, those types of periods, raising cash makes sense. During moments such as stock market corrections or COVID, black swan events, it really, at the end of the day, you're absolutely right. What you want to do from a tactical perspective is understand what's the market going through and what are the companies that are going to be best positioned as the market recovers. So there could be areas of the portfolio that struggle off the recovery, right? Maybe they were at the center of the COVID storm, and maybe we need to let those go and reposition for companies that are going to do well in a more digitized environment, which is exactly what we did in March of 2020. Going to cash just because you get client calls or because if you don't have to worry about the market going down for another 3 or 4 days, that's irresponsible. It basically puts a band-aid on a grave wound. And what happens is clients will feel better for a week or 2 weeks, but then a year, they're going to look back and say, well, the market went up 20 and I'm flat. What are you doing for my money? You just panicked and sold with everyone else. You weren't disciplined. You weren't using your brain. You weren't using numbers. You weren't using data. You were just panicking like everyone else. And so that's why investing is about long term, but it's also about understanding at what price can we buy valuable merchandise at, and where can we tactically rotate the portfolio, the best positioned clients in the best merchandise that our data suggests is available out there. So that's an absolutely great point there, Tim. And the example I like to use is Amazon. So when we look at Amazon, right, we don't own it in the portfolio currently. So, but it's just a really good example that a lot of people can relate to. What do we know about Amazon? Well, we know that Amazon is by far and away the leader of e-commerce, right? And we know that it suffered a 23% sell-off during COVID. So if we look at where we've circled the chart here, we saw this dip looked terrible in March of last year. 23% in a matter of weeks. People were selling Amazon. Meanwhile, that company was selling more and more widgets. Now, you could have prevented yourself from selling Amazon had you asked 3 basic questions. What are the structural trends that are in place in the economy? Well, we know, and this was true before COVID, during COVID, and after COVID, which is more and more shopping is being done online versus offline. That is a trend that remains in place and will continue to grow over time. What are the companies leading those trends? Well, I think it's very obvious that Amazon is the unabashed leader in that space. In fact, yesterday, Amazon just overtook Walmart to become the largest retailer in America. So those were the structural trends in place. And then, of course, is that company doing better or worse since the sell-off? And the answer was Amazon was selling exponentially more widgets and services in March of 2020 than they were in February of 2020. So in other words, this value line was going upward and to the right. That's an opportunity to stay disciplined if you're already invested, stay focused on where that value line is going, or if you do have money on the sidelines, to have positioned more money in a company such as Amazon to realize more wealth in the future. And what happened? Amazon went up 110% off that bottom. And if you look at that chart now, COVID almost seems like a mere blip. Notice what's happened recently. Amazon, with a lot of other growth-oriented companies, some of which we own, obviously, have had this correction here. But again, it's a blip as part of a broader secular growth theme that we see taking place in the economy. And that's why it's so important to remain focused. Don't get distracted by the media over 2 or 3 weeks. Why? 2 or 3 weeks is nothing in the broader aspect of our investment horizon. And so it's so important to remain disciplined. And that's really the way we look at companies in general, right? Just we want to remind investors a story of secular growth. As long as that value line is going upwards and to the right, we know one thing, our companies are always going to be in a constant state of positive and negative momentum. It's very rare that a stock trades at its actual fair value line. We're always going to be either in a state of being overbought or oversold. We just have to make sure that when stocks are overbought, we're not in the zone of overconfidence. They're not going to go up forever. They are going to check back. And then we're going to go into the zone of self-doubt. But then we ask our same 3 questions, right? What are those 3 questions? Secular growth themes that are taking place. What are the companies leading the charge? And are they doing better or worse since that pullback? If we can answer positive to all 3 of those questions, we want to remain disciplined or put more money to work. So, what happened through that March 2020 correction, right? We had 2 types of investors, Tim. We had one, the investor that invested right before COVID, right? So the timing could not have been worse, right? And you never like to see it. You never want to be that person because the timing sucks, right? There's no other way to put it. In February 19th, 2020, that was the peak of the market right before COVID really started to run amok across Europe and then eventually the US and the rest of the world. And what we saw is, those investors suffered a 35% drawdown in the value of their accounts. Those were hard phone calls, right? There's no there's no lipstick you can put on that pig. Your portfolio is down 35%, right? And what we had to do is we got on the phone and we walked through those 3 questions that we always talk about with clients and advisors. What are the secular themes that are taking place? Are they more powerful than the economy itself? What are the companies leading the charge, and are they doing better or worse than before the correction? And I'm pleased to say almost 99% of all clients bought into that message. And what we see is those investors, despite that 35% drawdown, and despite the recent correction that we've seen in our strategies over the last 2 or 3 weeks, are up 71.44% after fees since February 19th of 2020. If you had been invested with us at the very bottom, obviously the timing was great and you're up 168%. The bottom line here is that corrections are a moment to be opportunistic. Whether you invested right before the correction and you have some extra cash to put to work, or if you do have cash, you're a new client and you're looking to pull the trigger on our strategies, now is a great time to put money to work, because we know that most of the underlying companies, in our opinion, all of the underlying companies that are in our portfolio are doing much better now than they were a month ago. And those total potential returns have actually gone up since the correction started. One reminder, we talked about this last week, but just the bigger picture right now is our research does suggest that we remain in a 20-year secular bull market. And when we look at the S&P 500, 2009 to today, we are in the middle innings of this American resurgence, this defeat of deflation, right? So if we actually think of inflation right now, it's more of a reflation, getting out of the doldrums of that Japanese syndrome of secular deflation. 1982, we saw a 20-year secular bull market that was marked by the defeat of inflation. And then, of course, 1942 to 1968 was another 20-year secular bull market, which was really marked by the era of American supremacy across the world after the defeat of Nazi Germany and the Japanese Empire. So, every secular bull market tends to have these 20-year secular bull runs. And then in between those periods, we have 10-year periods where money is either generates no return in the stock market or is slightly down like we saw from 2000 to 2010. Real quick here. So what did the Federal Reserve say yesterday? So for the, they were remarkably consistent. What they said is, yes, there is some temporary reflation as the economy reopens, right? What do we also see? A lot of companies right now, as they're reopening, as they're starting their operations, there's a rush to rebuild inventories from last year. And that's causing some congestion at the ports, right? So we see container shipments are right now, the orders for container shipments are very, very high. Why? Because everyone's working to rebuild their inventories. So we see a lot of congestion there. And what I always like to remind people at is this is very similar to traffic patterns on a daily basis. So, our office is right next to Interstate 5 here in San Diego. And when we think of the traffic on a daily basis, we know for a fact that around 5 o'clock, we're going to get a traffic jam and it's going to be congested. Now, does that mean we're in a permanent state of congestion? No, of course not. By 7 o'clock, that traffic clears. And so what we're really seeing is that as companies reopen, as companies rebuild their inventories, there is this congestion to normalize back to February 2020 levels. And that's causing a temporary period of congestion that will eventually clear up as we get into April and May of this year. And so that's why that's what the Federal Reserve is trying to communicate to investors and to regular everyday Americans as it relates to the economy. They're not going to react and increase interest rates when we have so many Americans that remain in long-term unemployment. It just doesn't make a whole lot of sense. And we're not really seeing structural price increases on day-to-day goods. And we can see that if we go to the supermarket or if we go to Best Buy or whatever it is that we buy a lot of our household goods. In terms of the dot plot and where the Federal Reserve participants see interest rate policy, we could see this, the first chart, the first dot plot on the left is where how many people saw interest rate increases in 2022 and how many participants see interest rate increases this time around in the most recent meeting. We can see here, one person saw a interest rate increase in 2022 a meeting ago, and this time around, there's 4 that see an interest rate increase in 2022. But that's the key. In 2022, no one sees rate increases right now in 2021. And that's because there's a lot of slack that remains in the economy. So we're going to talk about what's causing the recent increase in the 10-year rate, but it's not the Federal Reserve and it's not inflation. But we're going to talk a little bit about this idea of normalization. So inflation. One thing that I was taught from one of my mentors in the business up in Toronto was that once a story reaches the headlines, once it reaches the front cover, you either want to buy it if it's a sell the news event, or you want to sell it if it's a positive story on the cover. Why? Because once a story reaches the cover, ladies and gentlemen, it's in there, it's in the price, everyone knows about it. Even people who don't go to the business section, they just read the newspaper casually, are aware of that since it's on the front page. The number of news stories mentioning inflation has absolutely skyrocketed over the last month and a half. And we've seen this time and time again. And if for those investors that watch our weekly update, you know that we've actually bring this up a couple of times, whether it was on inflation, whether it was the election, whether it was COVID. Each time you see this spike, that tends to be the point of maximum pain before things start to normalize again. And if we look at the TLT bond ETF, so if you've been invested in so-called risk-free assets such as long-term treasury bonds, you're actually down 20% since August of 2020. So a lot of pain there in the bond market. But the bonds are also very, very, very oversold. Now, we're a fan of stocks. We're a fan of investing in companies that are building equity value. But if I was a bond investor right now, I would actually be tempted to buy some long-term bonds just because of how oversold they are. The other thing we see is that future inflationary expectations actually are beginning to fall. So behind the scenes, behind the noise right now of everything else that's going on, the difference between the 10-year and the 5-year break-even rates, so where basically people see inflation, but over the next, not just over the next 5 years, but between year 5 and year 10, is actually starting to drop quite a bit. And so I think that's an important thing to pay attention to right now. A lot of times these data points don't rise to the surface tomorrow or today or next week, but they will certainly start to weigh on the bond market over the next month. And that's really key. So when we see this, it kind of confirms a lot of the data points that we're seeing, which is that inflation is not really there outside of a temporary bump as we come over those year-over-year comparisons versus March of last year, where we saw a big fall off because the economy got shut down. And you see that in the data. CPI has actually dropped. So when we look at the most recent CPI report, we can see that outside of a temporary rise that we saw in early fall, late summer of last year, we've been consistently heading down. Now, we do expect this to blip back up. Why? Because we're going to be coming over very low levels of March and April of last year when the economy was shut down and prices collapsed. That's artificial inflation. That's not real inflation. What you want to look at is, are prices structurally higher than they were back in February and December of 2020, and what's the rate at which they're increasing? We don't see a lot of rate of inflation once we normalize for this gap. So what is happening? Why are interest rates increasing? If it's not inflation, what is it? It's normalization, ladies and gentlemen. As the economy has reopened, what we've seen is that people are pulling out, dusting off those February 2020 playbooks, those January 2020 playbooks. What did the economy look like in January of 2020 before COVID hit? What were the themes that were in place in January of 2020? The banks, the cruise liners, the airlines, how did those businesses operate in January of 2020, right? And so what we're seeing is a normalization. Where were interest rates before COVID hit? And what we can see here is the 10-year rate at 1.66%. We're a little bit higher this morning, closer to about 1.75%, is that we're just going back to the period right before the collapse of interest rates in March of 2020. We are normalizing, ladies and gentlemen. Remember, back in December of 2019, we were at 2% interest rates on the 10-year rate. It's a very important point. 2% is cheap. 2% is easy money policy, as the FOMC likes to communicate. So what we're seeing is not inflation. What we're seeing is normalization. And we're very close to normalizing. We can see we're back to those late January, February levels. And we're seeing the same thing play out in the reopened stocks. So the airlines and the travel stocks in particular are right back to where they were in January and February of 2020. So the question is, these stocks are still, for example, airlines. Airline and airport traffic has recovered, but is still operating 40% below where it was in January and February of 2020, yet the stocks are above those levels where they were trading. So the question is, what's better value? Is it buying these reopened stocks that have largely anticipated a full recovery and have not actually realized a recovery yet, or companies that focus on long-term secular growth and are not just anticipating growth, but are realizing growth today? And we believe that the latter, the secular growth stocks, are the better long-term play at this point in time. And we know, one thing we know for certain is that stocks that tend to be at the center of the crisis do get this quick pop, right? Like, for example, the bank stocks had that quick pop right after 2009, it became clear that the Federal Reserve would not allow them to collapse, go bankrupt. And then though, they become dead money for the next 5 or 7 years. Why? Because they had to save themselves through raising debt. And when you raise a lot of debt to save your business, you spend the next few years repairing your balance sheet, servicing those increased debt levels, working off debt, not focus on growing the business. And that's really what hamstrings a lot of these businesses after a crisis. And we're seeing, like, if we look at the airlines, the cruise liners, in particular, raised a lot of debt to survive, right? Now, over the next few years, they're going to have to work that debt off. That's less incremental dollars that they can put toward ordering more airplanes, increasing the services that they're offering to customers. All of this stuff will be a hangover for those businesses. So it's something that's very important to remember, that we get a big pop and then we kind of tread water for the next few years. Meanwhile, on the tech side, we've heard a lot of talk about, is this a valuation bubble? Ladies and gentlemen, a picture says 1,000 words, and this is the PE relative valuation versus the S&P 500 going back to 1990. And we can see what 2000 really looked like, ladies and gentlemen. That's not where we're at today. We're actually below the long-term average of 1.19. And tech is just one component of our overall strategy, but an area that we really like and we really like for the long term. And when we look at valuations relative to the growth rate, we think it's quite attractive. And so I think just an important thing that we want to make sure that we separate noise from substance and stay focused on the long-term substance. And that's how companies ultimately grow. And that's reflected in the overall stock price. So overall, ladies and gentlemen, we've had a nice healthy pullback here in the market, in growth stocks in particular. That has included some of the stocks that we're invested in. But this is a fantastic opportunity. Not only that, it's a healthy correction. We were a little bit overbought, as we mentioned, in late January and February. We've seen those levels reset right back to the 200-day moving average. And now we're seeing a reset of the cycle. And so we want to see that. That's what creates long-term sustainable bull markets. So the three takeaways from today really should be: value creation outweighs the day trading noise that we're always just absolutely bombarded with on a day-to-day basis. Second, it's about normalization, not inflation. We're going back to where the economy was pre-COVID. So let's take a quick step back. Was Amazon a COVID stock? Did it benefit from COVID? Yes. But was Amazon dominant in 2019? Yes. Was Amazon dominant in 2015? Yes. Was Amazon dominant in 2010? Yes. In other words, just because a company did well during COVID does not make it a COVID stock. Very important point. Secular growth is more important, more dominant than these short-term trends. And then lastly, of course, stay focused on that secular growth. So Tim, thank you. As usual on a weekly basis, Tim is responsible for a lot of these charts. He does so much hard work for us. And if anyone has any questions for myself or Tim, please reach out to your advisor. They're working tirelessly day and night to make sure that your portfolios are properly positioned. And we're happy to take direct questions as well when you can reach your advisor. And just thank you so much for your business, your discipline, because that discipline through periods of last year, March 2020, is what really created the success that we're seeing today. And our focus on a daily basis is not just harping back to the success in the past, but how can we create success going forward? And that's our focus day in, day out. So if anyone has any questions, please feel to reach out and we'll be happy to answer any of those concerns. Thank you so much and have a fantastic week.